and it's the top three markets, which is the Bakken, North Dakota, and Permian Basin, West Texas oil field boom, and finally the Eagle Ford, South Texas oil boom investment opportunities. And but that said, today's webinar is very powerful, very important, and is a reflection of so many of you already logged in. I have a very high enrollment, very high attendee audience. So that tells me you guys will try to learn about loan strategies for investors, and which is very critical, right? Financing is all about leverage. It's all about making your money work hard, putting as little down payment as possible to leverage your investment, and using a lender, using a mortgage to help you to leverage your wealth. So my presenter today is one of my great team, a part of my great financial dream team, if you will, and the lending part of it. Mr. Jason Gaudreau of Security National Mortgage Company. He's been doing a lot of investment loans for my investors, especially in the past few years, and he's totally understand the mindset and the challenges that are associated with my real estate investors. And yep, he got a lot of things to cover. He will spend about 30 minutes on this presentation, and then the last 20 minutes of today's webinar, you have an opportunity, all of you, to type in your questions on your chat box on the lower right hand corner, and we're gonna do our best to address all of your questions, given the time frame we have available, the limited time. If I'm unable to address your questions, you can feel free to contact Jason directly, and his phone number is on the screen, right, on email as well. So without further ado, it's a pleasure to have Jason Gaudreau speak about loan strategies for real estate investors. So with that in mind, proceed, Jason.
All right. Welcome, everybody. Thank you for this opportunity to present to you guys today. I'm going to be honest, this is actually the first full-on webinar where I've had control that I've ever done. So you guys can beat me and kick me later if it's terrible. As Siri mentioned, my contact information is down below. I encourage you to contact me anytime, either email, office, or cell. I'm usually pretty good about getting back to everybody the same day, and I'm aware that everybody's situation is just a little bit different. So I'm here to hopefully clear up some of those questions for you guys. Keep in mind, with this presentation, it's going to be a high-level presentation, going over some of the guidelines for the different number of properties you have financed, as well as credit requirements. We're going to do a small blurb on commercial financing, which is becoming more prevalent, as well as some recent changes or some new changes coming to Fannie Mae on August 16th that will affect you. As we're going through, I guess I'm just presenting, and then you guys are going to hit me up with questions later. So moving on to the first slide. This is what we're going to learn today. Like I said, I want to keep it high level, so I want to go over a discussion on points and fees, which I think is very important to everybody out there. That oftentimes confuses people. Guidelines on 4 or less financed properties, guidelines from 4 to 10, and then guidelines for more than 10 and people with bad credit or no credit and income challenged clients. The Fannie Mae update followed by commercial properties. I get questions all the time. I've been lending up in North Dakota, and I've been working with Seawing now for a couple of years. Mostly California buyers. They're a little different than Utah buyers, which is where I'm located. In Utah, it's typical for everybody to pay 1 point on all their loans. I've discovered with California that's not necessarily the case. Everybody asks for no point loans, which is perfectly fine. I've asked several of the investors that I've been working with over the years do you know how much a point is? And I oftentimes get a blank on the other side of the phone, or they start asking me questions. So just for knowledge, 1 point is equal to 1% of your loan amount, not your purchase price, um, nothing else, but 1% of your loan amount. If you pay points, it does not necessarily lower your interest rate. Well, it never lowers your interest rate by the equivalent of what you're actually paying points on. So for example, if the interest rate's 5% and you pay 1 point, your rate doesn't go to 4%. Your rate would probably drop to 4.875%. To put that in real numbers, for a $250,000 home with 20% down, it's going to save you about $18 a month in your payment. So I'll let you guys do the math and determine whether it's beneficial to pay points or not to pay points. The other question I get from a lot of people is, I'm reading on the internet that interest rates are at 4.25% with no points. That's correct. That's exactly where they are today. If you're purchasing a primary residence with 25% down and you have a 740 credit score or better. This presentation is geared towards non-owner occupied properties, so for investors. Every layer of risk, and lenders view investment properties and credit scores less than 740 as an additional layer of risk. So we're starting today with the 4.25% with no points. If we're looking at an investment property with 20% down, 3.25 points is automatically being added to the pricing on your transaction. If you're purchasing a multifamily property, an additional point is being added. If you want to waive your escrow account, a 1/4 point is being added. This actually needs to be, I apologize, this slide needs to be updated a little bit. That's actually a 740 score, not 720. If you have less than 740, there's also credit adjustments to your loan. These adjustments to the interest rate are all cumulative. So if you're putting 20% down, you have a really low 600 credit score, and you're buying a fourplex, you're probably looking at rates of somewhere around 5.25 with no points, versus somebody putting 25% down with a 740 or better score, you're looking at an interest rate of somewhere around 4.625 with no points. Moving on to the next slide, here's some guidelines for less than 4 financed properties. Previously, the history behind this, every lender used to finance up to 10 properties. This was back pre-2008. After 2008, the investors on all these loans, Wells Fargo, Bank of America, U.S. Bank, they put the restriction, the cap of 4 financed properties on everybody, because they recognized that the risk when people owned more than 4 or had more than 4 financed went up drastically. Throughout that period of time, Fannie Mae always maintained that you could have 10 financed properties. But these are the guidelines for less than 4 from all these main investors that we sell loans to. So if you're purchasing a single-family home, townhome, or a condo, you need a minimum of a 620 score and a 20% minimum down payment. There are 15% down payment loans available for investment properties. However, I have not been able to locate any mortgage insurance for those properties. So it's essentially a dead product until a mortgage insurance company comes forward and allows for insurance on those. For multifamily properties, so if you're purchasing 2 units to 4 units, you're looking at a minimum of a 660 score, and you need a minimum of 25% down payment. The one piece that catches a lot of people by surprise are the reserve requirements. So reserves, mortgage reserves, you obviously need enough money for your down payment. You also need enough money for your closing costs. The lender is also looking for you to have 6 months reserves on the subject property plus 2 months of reserves for all your other properties. And that's PITI. So keep in mind, if you have if your payment's going to be $1,000 on the property you're buying, you're going to need at least $6,000 put in reserves plus 2 months reserves for each of your other properties. And those reserves can be in the form of a 401k, an IRA, any form of retirement or savings that you may have, even outside of liquid funds. Moving on, so if you have between 4 and 10 financed properties, which is where several of these you guys have been that I've spoken with, it changes things a little bit. These loans go direct to Fannie Mae. They're not passing through a Wells Fargo or a Bank of America. You need a minimum of a 720 credit score. This catches a lot of people by surprise because of the drastic difference between less than 4. So please keep that guideline in mind. It also increases your down payment by 5% to a minimum of 25% down for a single family home. In most of the properties that Sea-Wing I've been working on with Sea-Wing up in North Dakota, Texas, Indiana, those places are all single family or townhomes. So we haven't come across the multifamily 2-4 units. They also require a 720 minimum score, but they require a 30% down payment. And the big difference here on your reserves, you need 6 months reserves on the subject plus 6 months reserves instead of 2 on each additional finance property. So please keep that in mind. So I get this question quite often from a lot of people. What if I have more than 10 finance properties? I had a foreclosure 2 years ago. Is there anything I can do? I'm self-employed. I don't show any income on my tax returns. I write it all off. Is there any way that I can buy a property? The answer is yes, you can. We refer to this as our soft, hard money kind of loan. It's really an alternative loan. For all these properties that Sea-Wing has been talking to you guys about, the cash flow on these properties is huge. And the interest rates on this loan are higher than a conventional loan, but they still enable you to have significant cash flow and get your foot in the door and take advantage of these opportunities now. To walk through these guidelines, it's offered in a full doc and a stated income transaction. The people that are credit challenged and have a great job, providing your income documentation is the best way to go. Your rate's going to be 7.99. For the people that don't show any income on their tax returns, obviously the stated income option would be the best option. And that rate's 8.99. This is an asset-based loan. What that means is it's being based on the collateral of the property plus your down payment. So even though it's stated income, we still have to verify your down payment. We have to verify. There's no reserve requirement, so we can avoid that. This loan requires 35% down. It's a 30-year amortization loan with a 5-year balloon, and there's no prepayment penalty. I've had quite a few questions. People have asked if they can make this a 15-year amortized loan, and I believe that we can. I haven't done one yet, but I don't see any reason why we can't. It's good for 1 to 4 units. No condos are allowed, which is fine. I mean, these properties that Sea-Wing's been looking at haven't fit into that. It works for purchase, rate and term, cash out, up to 50%. What we've been primarily working on, those purchase transactions, so you're looking 35% down on 1 to 4 units. With no credit score requirement, your credit is still going to be pulled. They do want to see, the lender wants to see, the underwriter wants to see what is on your credit to determine, have you had a bankruptcy or foreclosure? Do you have score at all? Why is your score low? One of the things that helps me do is it helps me work with you on improving your credit so that in that 5-year period of time we can refinance that property and get you prepared either. Um, year for an additional fee. Please, if you guys have any questions about this loan, give me a call. I've received a lot of inquiries on this lately. Like I said, due to the previous credit challenges. Fannie Mae updates beginning August 16th. This is a pretty big announcement from Fannie Mae, and this is in response to all the boomerang buyers, which is the passe or new term word being used for buyers that have had short sales, 2011, 12, 13, that took advantage of selling their properties low and are now ready to jump back in. Fannie Mae has, if applications after August 16th, you no longer have a 2-year waiting period outside of your short sale. You have a 4-year waiting period with 20% down. Please keep this in mind. If you are one of these clients, then it's definitely advantageous to get your loan app submitted prior to August 15th date, or we're going to be looking at the soft hard money kind of loan with rates, 7.99, 8.99. Commercial multifamily. This is something that Seawing and I have been talking about quite a bit over the last 6 months. And I'm going to keep this pretty broad and pretty high level. Commercial lending is completely different than residential lending. Residential properties are defined as properties of 1 to 4 units. The lender is qualifying you on a residential property. They're looking at your tax return, your credit history, your income. They care about the property, but they care more about, can you service this property, the income that you receive from the property and from your job. Commercial lending is strictly based upon the qualifying of the property and not so much you. So it flips the coin, and the property has the debt service the property. Your personal situations, your credit, your income, those things, they come into play loosely. And what I mean by that, if you have a 5 credit score and you had foreclosures a couple months ago on a bunch of investment properties, your job history's been weak, there's a good will deny the loan for your history. However, 9 times out of 10, if you have a 550 credit score, it's because you had a few waits, you had lost your job, you're back employed, you had a short sale 3 years ago. They're fine. It's not specifically focused on credit score. For on family property, so 5 units and up, commercial lending is very. These are the highlights for multifamily versus house versus over gas station versus is a rural financing loan, which allows you to go up to 80% loan to value. They're 30-year terms with rates that vary between 4.75% and 6%. They're 5.7, and all commercials or 90 prepay. Declining prepay. So in year 1, you have a 4%. In year 2, it's a 3% prepayment penalty. In year, et cetera, it goes down. They consider if you pay more than 20% a given year, that is prepaying. That would activate the prepayment penalty. Um, if rural financing is not available, conventional financing is. You're looking at 70% loan to value with 25-year terms. The rate is stable between 5.25 and 5.5. Um, and the interest rates on these arms follow either the LIBOR or the Treasury index, similar to residential lending. Um, you need to have properties uh, that are just coming out of the ground up in North Dakota. Um, these properties are much easier to finance um, when there's a lease that's in place. Um, However, they still can be leased. They still can be financed even if there's no lease in place. As I mentioned, your personal credit and personal incomes are only minimally considered. I also get a lot of questions from people on debt service ratio, called DSR. Uh, you guys can kind of calculate this even for yourselves. You take what most investor or most banks do or lender writers do. Though if it's available, they'll take the last 2 to 3 years of financials or tax returns from that business. Um, they'll take the income on that property. They'll divide by the total expenses on that property. Um, and they want to see a 25% or more ratio from income to expenses. On these brand new properties that are just coming out of the ground, as you guys are figuring these out, CWIN can give you an idea on where rents are at. Per unit, I'm assuming they're 3,000 or more per month. Um, you calculate your PITI, your management fees. You factor in an average repair cost. Um, and what we do in the residential world is we take 75% of the gross rents, um, and that's what we're operating off of. So you can assume your management fees, average repairs, and those things amount to 25% of what the gross income is. And that's my presentation. I don't know if I